Take a slow breath in. Allow your attention to settle. Now imagine yourself walking into an investor meeting. The numbers you are bringing into the room are strong. Revenue has been growing steadily. Retention remains consistent. Margins have continued to improve. The projections you prepared are grounded in real performance. You enter the conversation knowing the data supports the story. The meeting begins smoothly. Investors ask about the product. Then the discussion moves to traction, then to market positioning. You answer clearly because you prepared carefully. The conversation moves forward in a familiar rhythm. Then one investor leans forward and asks a different question. What happens if growth slows next quarter? The room becomes quiet. You recognize what the question is really testing. The investors have already reviewed the numbers. What they are watching now is how you think when the future becomes uncertain. In meetings like this, people notice more than the forecast. They notice how you organize risk. They notice whether your thinking becomes clearer when the questions become harder. They notice whether your tone remains steady when uncertainty enters the discussion. That steadiness communicates something important. It shows that the company is being led by someone who can evaluate risk without losing direction. You slow your pace slightly before responding. Our main exposure right now is customer acquisition efficiency. If that tightens, we reduce acquisition spend, we protect margin, then we shift attention toward retention. We monitor payback weekly so we can adjust early. The explanation changes the tone of the room. The risk is now defined. The signal is clear, and the adjustment has already been considered. Another investor asks a follow-up question. Which assumption in your forecast carries the most risk? You pause for a moment before answering. Our expansion depends on mid-market conversion staying within this range. If conversion moves outside that range, we pause hiring. We extend runway. Then we evaluate the channel before scaling again. The conversation becomes more focused. Investors are not expecting perfect predictions. What they're looking for is evidence of disciplined thinking. They want to see that risk is recognized early. They want to see that decisions will be adjusted when signals change. Before meetings like this, you prepare in a specific way. You think through a few questions in advance. Where is the plan most exposed? What signal would tell us that conditions are changing? And what adjustment would we make first if that signal appears? When those answers are clear, the meeting feels different. You are not reacting to questions. You are explaining how decisions will be made when conditions shift. The discussion becomes calmer. Investors begin to understand how the company will respond if the environment becomes more difficult. Over time, the conversation becomes less about persuasion. It becomes about alignment. They see how the business will be managed when uncertainty appears. As the meeting concludes, you leave with the same steady focus you carried into the room. The numbers open the conversation. Your clarity under pressure strengthens confidence in the leadership behind them. And as you walk away, one insight remains clear. In rooms where capital is allocated, confidence rarely comes from perfect forecasts. It grows from disciplined thinking when the future is still uncertain. You move forward composed and deliberate.